Hello, everybody out there. How are you doing? I hope you are doing well. My name is Andrew Kuhn. Thank you very much for tuning into the Focus Compounding Podcast. Geoff Gannon, how are you doing over there?
I'm doing very good, Andrew.
Did you get over your sickness from a couple episodes ago?
Yes, all over. It's done.
You're good?
Mm-hmm.
All good. Now all good. We want to thank everybody for tuning in and listening to us today. Of course, as you know, if you are a regular listener, this is the Focus Compounding Podcast, the audio part of our business. We do have a writing part of our business or an idea part of our business, and that's at focuscompounding.com, where individuals, professional investors, and individual investors, they contribute and write about ideas on our website. So feel free to go to focuscompounding.com if you do want to sign up. If you like discounts, some people may not. I don't know. I'm not here to judge. Use podcasts, and they'll take $10 off your subscription price indefinitely, as long as you do say a member. So somebody emailed into us, and he said he'd like to say anonymous. So we're going to call him Frank.
Okay.
And Frank says, recently, in episode 43, I think, you dropped the notion of bad NetNets, and that got me thinking. What would you describe as a bad NetNet, and what are the characteristics of a good NetNet? And you've written very publicly about NetNets. I think there's actually a video on your blog I saw a long time ago of you talking about NetNets.
There certainly was a video at one time. I wonder if it's still hosted. We'll see.
Yeah. People are going to your website.
People are going right now.
GannonOnTheMessage.com. And I thought it was this is obviously a good question to go over, because a lot of people that do listen to us, they have probably followed you for years, and obviously you've hit on NetNets in the past.
Sure.
So it's a good place to go over. So what do you think are characteristics of a good NetNet?
So characteristics of a good...
First off, what is a NetNet?
Oh, NetNet. NetNet is a stock where current assets minus total liabilities is greater than the total market cap.
And this sort of came about probably from like Grahamites, I guess you could say.
Yeah, Ben Graham came up with this concept.
Yeah.
So for people to understand that in terms of the theory of why it works, is that basically, in theory, this doesn't always work out in practice, you have a stock that's selling for more dead than alive. Basically, you could liquidate the business and it would cover the amount that investors today could be paying for the entire company's stock, right? And what we're mostly talking about is cash, receivables, and inventory, minus all the liabilities, and that's greater than what all the stock is selling for in the market.
Yeah, and that's, I mean, a lot of the old, like Walter Schloss and Warren Buffett and all those old sort of super investors, I guess you could say, they all sort of followed probably in the early days this philosophy, right? And then what, you think a lot of people, it became sort of popularized and then it sort of got arbitraged away in the market? Or because you don't really come across a lot of NetNets today.
In normal times in the U.S., you don't come across a meaningful number of NetNets at all.
Yeah. So what do you think are characteristics of, let's start with the bad ones first, because I mean, I could think probably like high debt and certain things like that. But
so dangerous ones can be a problem, but that's pretty easy to screen for. So if you think about the formula that I just gave you, it's basically cash plus receivables plus inventory minus total liabilities is greater than market cap. But one way that you can do that is cash plus receivables plus inventory divided by total liabilities. And I'll give you an idea of the leverage, because I just did it as a plus and minus this thing, which actually means that if the stock had $11 in current assets, $9 in total liabilities, and the stock was trading for $1 a share, you would think it was trading at a 50% discount to its net current assets. And literally that's true. But let's think about it. Yeah. The margin between 11 and 9 is really tight.
Yeah, that's not good. Yeah.
So that company could go broke. But there are other ones where the current assets might be $10 a share. The total liabilities might be $1 a share. So you have $9 in net current assets, and then the stock is trading for $5. Okay. Well, that by the math is very similar in terms of what it'll show up on a screen, but in reality, it's much safer. So what you just said is true. Ones where there's a very tiny difference between current assets and total liabilities may not be attractive because there's so much leverage there. Sure. Now, if they succeed, you could get huge returns in them, obviously. But that's, in a sense, very leveraged. You could think of it that way. So bad NetNet means that the quality of the assets are poor, which generally means that they're specialized assets with a low return. So I said cash, receivables, inventory. Cash is a general asset. It's liquid. You can take it out of the business. You can buy things with it. So cash is always good. It's a good net. Cash is always better than having some other asset that's carried at the same amount there. So that would be attractive. The bad thing that NetNets can have is if they have inventory and receivables where there's something wrong with them. In particular, inventory tends to be the problem here. There can be other things like they have property, plant, and equipment, which we don't count, but can kind of become a liability because they keep investing in something that earns low returns. So generally, the same things that work with companies for the most part, which is that their assets are productive. So you want NetNets where the assets are productive.
And how do you sort of measure that? Like, is it like a return on assets type calculation? Yeah. Mm-hmm.
So I invested in a stock called George Risk. It probably earned, I don't know, 30% or so returns on capital, or maybe those were after-tax returns, but very high returns if you took out the cash.
Yeah.
And the cash wasn't really in the business, so you should take it out to judge the business. And so the business is something earning 30% returns. I found other things that might be earning 5% returns generally in them. So the actual business itself earning poor returns is a problem. Yeah. The assets being less liquid and lower quality can be a problem. So inventory that isn't good. I think on a previous podcast I mentioned a stock which was originally called Duckwall Alco.
Can you say that again?
Duckwall Alco.
Say that 3 times fast. No, I'm just kidding.
And that stock was rural, sort of. I don't know if we want to call them general stores. They were. The inventory was not very valuable because it was misplaced. Mm-hmm. So it's inventory which is in rural areas. Well, inventory isn't very valuable in rural areas. It won't turn fast. You can't sell it very quickly, right? So if we imagine the same things and they're in where, I grew up in northern New Jersey, or they're here in Dallas-Fort Worth area, right? If you have that inventory, there's a lot of people you can sell it to, right? But now take it out and put it in the middle of someplace in Kansas that's nowhere near any metropolitan area and try to sell it. It'll take a long time to sell. But you see on the books, it appears the same way.
Yeah, sure.
It'll show up in Dallas-Fort Worth and in some random place in rural Kansas as if it has the same value.
Yeah, totally.
But it really doesn't, because that's not very liquid, that inventory that you have. It could take a long time to turn. And the only reason why you get decent margins at all is because there's no competition out there. Right, so that can be unattractive that way. So that's a bad NetNet.
I think it's a good way of doing it. Yeah.
Yeah.
What about a good one then?
So good ones,
the opposite.
Yeah, good ones are the opposite of that. They have very little inventory. Receivables can be okay.
Do you always value receivables at 100% of face value?
To do the calculation to see if it's a net, and I value everything at 100%.
Yeah.
The idea is that Graham valued it, I guess, at like.
I was gonna say, I think in like security analysis when he talked about it, he sort of haircut it a little bit, maybe.
So like cash was maybe 100%, maybe receivables was 85,
exactly.
and maybe inventory was 0 to 50 or something like that.
It like roughly like that.
Yeah, and that's a fair way to assess it in liquidation probably. Yeah, and I have seen companies with receivables that I don't think are very good. You could have related party receivables that are big. I've seen receivables in some cases that aren't good because the customer is not a great credit risk. And this, by the way, that we're talking about works under GAAP in the U.S. It'd actually be different in some other countries. So because remember that they're reserving for things, so they can take a provision for losses on receivables. Sure. They're carrying inventory at the lower of cost or market, things like that. So generally, they're being a little more conservative. If you're directly charging off bad debt and stuff, bad receivables, like you might in some other countries, then the NetNet might appear cheaper in another country than it really is, because the U.S. way of accounting for it might be more conservative when it comes to current assets.
What is the last NetNet that you invested in?
The last one I sold was George Risk.
And how long ago was that?
I don't know. A year and a half ago.
Do you actually like the business characteristics of George Risk? Did you like
it's an excellent business.
Yeah.
Yeah.
Was that like a rare situation when especially nowadays, finding a great business trading? I don't know if you characterize it as great, but you said good business trading, as a NetNet.
Yeah, it didn't grow, but in terms of like a great business, in terms of just the economics of it, yeah. That's rare. I found a couple that are that way. They generally don't grow. That's why.
Were the ones that you invested in when you did the Japanese? Were those all NetNets?
All NetNets. Not only just all NetNets, all net cash. George Risk was also net cash. Most of the NetNets I've ever bought have been net cash.
Really?
They sell for less than
Do you
cash.
think that's a good way to sort of go about it?
Yeah.
Because there could be situations where...
Here's the thing.
I don't want to say frauds, but just bad situations with NetNets or what?
Oh, that's possible, yeah. I don't know. I don't think that I could be wrong. One day there'll be a fraud in the thing that I talked about. But I think generally it's not that hard to detect what might be a fraud and what might not be in this kind of thing, like NetNets and things like that. Because if the company hasn't raised money in 20-some years, if you can see that it's family controlled thing, that it's paid out dividends, that it does whatever things that it does, you can often tell that it's probably a legitimate business.
Sure.
Whereas if you can see, like there have been some cases with Chinese ones and stuff listed in the U.S. Where they claim they have a lot of cash, but they don't want to pay a dividend. And then if they'll borrow money at the same time they claim they have cash.
So it's like pretty
like
obvious,
that.
yeah, does it?
Yeah, in each case, there's always a possible explanation.
Sure.
Yeah, they could be right. There could be a reason to borrow a lot of money at the same time that you have a lot of cash and things like that. But those are things that tip you off that it might be a NetNet, to be a fraudulent NetNet. But the ones that are good are the ones where they don't care about talking about it. They don't really care about driving up the stock price. They never issue stock. What's the point of having that as a fraud?
What do they say? Listen to what people do, not what they say.
Mm-hmm. That's true. And usually have a long record. You can say kind of stuff to see a long record there.
So when you screen for NetNets, what do you think is a good screen to use?
Well, I prefer finding ones that trade for net cash.
Okay.
And then I prefer to have them have a very long history.
Why do you prefer net cash? You think it's safer? Probably.
Yeah. So basically, I'd say all the NetNets, I could be wrong about that, but I feel like all the NetNets I've ever bought have been net cash stocks that were had positive net income at the time that I bought them. They weren't losing money. And in most cases, I like ones that had a long history of profitability, so no losses for many years in a row. I don't remember with George Risk exactly, but I would guess that at the time I bought it, in the last 20 years, they may have had one losing year.
Wow.
Which is not only good for NetNet, it's actually good for your average business on the U.S. Stock exchanges.
Do you still follow George Risk?
Not really.
Somebody actually emailed me within the past, I don't know, some 3, 4, 5 months that he was actually looking at George Risk recently.
Yeah. No, I mean, it could still be a good investment that way. And I wouldn't be surprised if it outperforms the market or whatever, pays a decent dividend, has cash,
Yeah. What about so George Risk was the last one that you invested in?
It's the last one I sold. I don't know if it's the last one I bought.
Have you had any bad situations in NetNets?
I don't think so.
And do you think that comes from you probably sticking to net cash and companies that are profitable? Because I think those are incredibly good screens to use.
That might not be true. I might have had I think I'm wrong about that. I think I had a bad experience in a NetNet, but it was not an OTC NetNet.
Oh, really?
It was a very big NetNet. I think so.
That was going to be my next question, actually.
Yes.
About big companies being NetNets.
No, OTC is much better.
Why is that?
Small. Not that it's much better.
You probably because you get more gems or what?
So they're more overlooked if they're OTC things. If they're a NetNet that's a big NetNet, they could come back in a huge way. And eventually they can make an incredible amount of money, returns for stockholders, because they're eventually going to be valued like a normal stock. And so on a major exchange, it could get very popular. And some things have been borderline NetNets or actual NetNets and then went on to be sold for a lot of money to someone or whatever. So big stocks. But in general, I'd say, I prefer the small stocks because it's kind of the idea of people are overlooking the small stocks and they're bored with them and they're selling out just because I owned George Risk for 6.5 years, something sold it. I didn't think it was expensive. I just was selling it thinking I was going to buy something else.
Sure.
I didn't think it was the best thing in the portfolio, but I certainly didn't think it was the riskiest or anything. Whereas the reason why people are dumping something on a major exchange that's dropped from being a $2 billion stock to a, $500 million stock or something and it's now a NetNet, that's because they're in fear. It's usually losing money. They hate the industry. It might be very cyclical, all sorts of things like that. So those tend to be more like fear in those. Yeah.
From your experience, have you found that there's more acquisitions in that pond?
With NetNets?
Yes.
No, because I find that NetNets are often controlled companies and things like that, so it's less common that they're taken over than you might think.
Wow.
Yeah. But what I would say is that they tend to follow the same sort of pattern that you see with a lot of stocks over long periods of time, which is if you start with a list of 10 NetNets. At the end of 10 years, a lot of people expect there's going to be these NetNets that sort of did nothing for 10 years, and that's not what happened. You have some that go broke, and then you'll have others that did really well. And the outcomes will be very binary that way, where you have these really positive outcomes for some of them and these really negative ones for others. And I think people are very afraid of dead money NetNets.
Sure.
And I just don't, in the records that I've seen, I just don't buy that as being that likely.
Do you still think that's a pretty viable investment strategy, is buy a basket of them and hold them?
You can't do it in the U.S. right now.
Yeah.
So buying a basket, no. And I don't know how important it is to buy a basket. People say that you should buy baskets of NetNets, and because of the risk that would be involved and stuff. I haven't seen that they're necessarily that much riskier than other kinds of stocks that way.
Sure.
People are afraid that they are, but I think that if you mix NetNets in with any other portfolio you have, I think that's fine. So if you have a portfolio of 20 stocks and the other 19 are non-NetNets, but you find this one good NetNet, throw it in there. There's no need that it has to be some sort of basket,
Yeah.
But you can't do it in the U.S. right now. If there comes a time where you will have an opportunity to buy a lot of them, then, sure, a basket then would make sense. We find some. I wrote about, I wrote about one for the focused compounding, which is net cash. And, it's an attractive stock, but you can't find 5 of them. So if you want to do a basket of NetNets, no, you can't do that.
Doesn't make sense to do it.
But anytime you find one, I just say, put it away.
Yeah.
Buy it and put it away for a while and see what happens. Anytime you find a NetNet that you think is decent, a good NetNet.
How long did you hold George risk for?
6.5 years.
Wow.
Yeah. And like I said, it did not outperform the market. Did not. The market did well. I forget. It may have been about 9% a year in capital appreciation plus a dividend. They hit a special dividend, but mostly the yield was in the 3 to 5% range, something like that. So I don't know if what the exact return on it was, but say you earned 12, 13% a year or something, but the market did too for those 6.5 years. The market did great. But I wouldn't be worried about something that you think is this boring stock. You bought it, nothing happened with it for 6.5 years, and it returned more than 10% a year. Mm-hmm. Because there could be a market that's not very good, and it could also have returned 10% a year or something. It's very likely if there was a bear market that George Risk would have outperformed other stocks. You're just comparing it to something that had really good returns.
Yeah. No, I think that's a good way of thinking about it. Any other thoughts on the topic?
No, I think that good NetNets are a lot like other kinds of good companies.
Sure. That you shouldn't be biased not towards something because it's a NetNet or whatever. Like
usually, good NetNets are financially solid, long history of profitability. They have high returns on capital, and they don't tie up a lot of money in bad assets. That's the key thing. The difference between a good NetNet and a bad NetNet is usually that bad NetNet has tied up most of its assets in something that's genuinely just not terrible. A good business.
Yeah.
It's distributing something that turns very slowly, and so all its inventory is in something that turns slowly or something. You just try to do the math on saying, what do I think the return on their inventory is? And if it's really bad, and that's what most of their assets are, then that's a bad NetNet. If most of the assets are cash, it's less important how good or bad the business is, obviously, right? But just generally, it's kind of better, I think, not to think what's a good NetNet, but think what's a bad NetNet and then invert it. So a bad NetNet is like any bad business. It's putting money into low-returning things.
Sure.
You could have that if it was a railroad and they were getting low returns because they put a lot of things into physical assets. Same thing. Just avoid things that have most of their money tied up in low-returning assets.
I think that's a good place to stop. Okay. And I think that was a pretty good explanation of it. We want to thank everybody for tuning in and listening to us today on the Focus Compounding Podcast. Have you ever written about NetNets in a memo yet?
I don't think I have written about NetNets in a memo.
Well, maybe Geoff will write about NetNets in a memo if you want to get access to that for a future memo. Go to focuscompounding.com, and on the homepage, you'll see a spot to enter in your email, and you will get a memo from Geoff on a investment principle every Sunday, 500 words minimum. Usually more than that, right?
It's one page. You'll get one page. You'll get a one-page PDF. Is that what they get?
Yeah.
Okay, one-page PDF is what you'll get in your email inbox Sunday.
You got it. Everyone, thank you very much for tuning in. Have a great day. Take care.